Yes. Jermaine Sullivan.
Here.
Liz Lasky.
Here.
Doug Parks.
Here.
Ed Bradford.
Here.
Bill Gamble and Jeff Rowe are not able to make it today.
Okay, old business Asher Oil royalties.
The saga continues. I've been working with the previous owners, Hound Resources. They've been working with Asher Oil, even though transaction has closed a long time ago, to try to get them to be functional accounting-wise. And they're having problems. Sent another note to them. Haven't heard anything. I'm going to give them a little bit more time. Probably send them one more little sharply worded email if I haven't heard from them. Fire a shot across the bow, either from the city attorney or through the regulator of the wells down at the state of Michigan. So we've got some dry ammo in the keg, but the time that they have not paid the royalties is starting to get a little excessive. But with that said, we had a similar situation when Hound bought them because the accounting was really messed up. I don't think the accounting is messed up as much as it is. I'm not sure Asher Oil is up to speed with what their back office is supposed to be doing. Might be a little bit of a big bite for them, but we'll get there, and we'll get the back royalties. It just takes time, so that's where we're at.
Is that typical of these companies?
There's very little regulation and oversight of these companies. The state audits them maybe once every 3 years.
Okay. 'Cause I've been
Far
seeing
behind.
them for years, and I feel like we've had the same.
Yeah,
Saga.
we always get the back royalties. We just, sometimes they're not timely.
How far behind are we?
Over a year.
Okay, so we haven't gotten any royalty.
Now, to be fair to Asher Oil, the transaction closed last July, and the state didn't, not this July, year in 24, the state didn't really approve everything for like 8 or 9 months. They had to fix some issues at the plant and some of that stuff. So there's a bunch of that going on in the background too. It's just an unfortunate situation. And I fielded some calls from a few residents. I've talked them through and I gave them my contact information. But a lot of what goes on here is these royalty checks are so small for a lot of the people in the city that somebody dies and they don't file the paperwork, and there's very specific things, they have to get all the estate paperwork to be able to transfer stuff, and so there's some of that frustration is self-created because they haven't kept up with their end of the bargain either. So, but we'll get there. It's just going to take a little more time.
So you're saying no accounting and no checks? Just
I'm not saying they're not doing accounting. I'm saying
Okay.
they're struggling to probably do the volume of royalty holders and get things up, and they don't want to issue checks out, presumably until they get it all right.
Okay.
But on the flip side of that, I think sometimes they use, the city and the state is also a big royalty holder, so the state's just as affected as we are, kind of as a bank, right?
Right.
But we'll get there, and I'll chat with the state one way or another and see if they're having a similar experience. And sometimes the regulator can give them a call and light a little fire under them.
Are they giving us the reports that say what it should be, or are we getting no reports? Just nothing?
There's no requirement
No.
for them to do that.
Okay.
They send us the statements when we get the checks that show them.
That's, yes, okay.
So,
Okay. Approval of minutes from August 2025.
So moved.
Support. Second.
Do you want roll on that?
Just voice vote.
Okay.
Fine. Yep. All in favor.
All in favor?
aye.
Aye. Investment advisor update and commentary.
Shall we start?
Yeah.
Great. Okay. Well, thanks for having us. I think you know the team. I'm Woody, and we've got Brian and John here. And before we jump into the materials, I'd like to thank you for making the accommodation on the meeting change, and thanks to Kelly for making all the arrangements. I think if we, what we'll do is we'll kind of go through the normal routine, which is we'll talk about some of the economic backdrop in terms of the what's going on with the capital markets and the economies, and then we'll dive into the portfolio, and along the way we'll all kind of chip in. You may recall Troy had been with us for many years, and then about a year or so ago, John joined us, maybe 2 or 3 meetings ago. And John is responsible for all of the fixed income assets, and Brian handles, he's kind of the utility infielder at Bartlett. I should say all-star utility infielder. He's knowledgeable about all the things that we do. So that's great. So let's go into the the page, Bartlett's market assessment, and thank you. And so I'll touch on a few things, and then John and Brian will chime in as they want. This page, I think that I may have mentioned this at the last meeting, but resilience continues to be the word of the day in terms of kind of describing what's going on with the economy and households. We continue, in spite of forecasts of recession that have really been kind of hanging around for years now. The economy continues to grow. We have low inflation. We have low interest rates. We have low unemployment. Corporate profits are growing. The economy's growing. We do have increasing disparity between, the higher wealth and income or households, let's say the top 10 or 20% versus the bottom 50%. There's kind of a widening gulf there. And I think that might even become more accentuated because of AI. You're starting to see some really large companies like Amazon and JP Morgan announcing cutbacks in the face of companies that are very healthy and growing, and companies with productivity tools are finding ways to grow with fewer people. It's quite an interesting time. But you can see under the areas of caution, we still have a lot of unpredictable policies coming out of Washington, a lot of flip-flopping and uncertainty, and we have elevated valuations. What that means is stocks are not cheap, and as John will talk later, bonds are not cheap. They're reflecting an appetite for risk and an outlook that's quite positive for the economy. It's not really factoring in any bad news. So I think that the next page is really kind of the dashboard of what we just talked about. You can see inflation, 2.9, unemployment, 4%, GDP growing at a good rate, 10-year U.S. Treasury bonds yielding about 4%, and corporate earnings are growing at a very healthy clip. So I think some of these following pages, I don't know that we need to dwell on any. Maybe if John or Brian, you want to take a minute on hitting on any of these, but I'll defer maybe to start with John.
Yeah, I think we can just hit a couple of these very quickly and then move on to the portfolio. Inflation's continues to be a key topic, and you can see the most recent reading is kind of held steady at 2.9%. A little surprising, just given all of the tariffs that have been enacted this year. And a key reason of why the rate hasn't increased more is that housing is a huge component of CPI. It's around 40%, and housing prices have really slowed down to basically be flat over the last year, and so that's kind of put a lid on the impact of tariffs on the overall CPI number. So what that's done is it's given the Fed ammunition to cut rates here in the last couple meetings. Market's pricing in another cut in December, and it's allowed the Fed to focus more on some softness in the job market. John, do you want to comment at all on the changes in the yield curve?
Yes, as far as the yield curve goes, so we're comparing two different points of time here on the U.S. Treasury yield curve, the green line being the end of March, blue line being the end of September. And what you'll notice is the shorter end of that yield curve, the 1, 2, 3, 5 year, have come lower. And that's simply behind the two Fed rate cuts. Yes.
John, sorry to interrupt, but maybe you could explain what a yield curve is.
Oh, sure. Yeah. Sure. So I'm sure everyone has heard about or is familiar with the massive amounts of government debt that is outstanding that our fiscal friends in Washington continue to take on. Well, in order to fund that debt, the U.S. Treasury issues fixed income securities at various points in time. And the yield curve is simply a representation of the different points in time that the U.S. Treasury is issuing bonds. And so investors such as ourselves are continually buying or purchasing these securities in the open market. In order to, again, continue to fund the enormous deficit and debt that the government has, what they continue to do is just issue different Treasury securities. Now, a large part of what type of yield that the U.S. Treasury has to pay investors such as us to purchase these individual securities is largely defined by what the Federal Reserve is doing, especially on the short end of the yield curve. When I say the short end, I'm talking more the 1, 2, 3, 5 year part of the curve. And so as the Federal Reserve adjusts interest rates lower, as Brian alluded to at the last 2 Fed meetings, the most recent of which was just Wednesday of this week, you can see that the short end of that yield curve, the 1 to 3, 1 to 5 year part of the curve, is really reflecting that lower area or lower rates that we're seeing out of the Federal Reserve. Now, as you move out to the 7, 10, 30 year part of the U.S. Treasury yield curve, that's really driven by expectations, market expectations about what the Federal Reserve is going to do in the future. Also, expectations about where economic conditions will be at longer periods of time. And you can see that the longer end of the yield curve has not adjusted nearly as much as what the short end has done. And I think that's largely behind the fact that inflation is still, as Brian said, inflation is still somewhat high relative to where the Fed wants to see it. The Fed would love to see inflation hit that 2% target. Well, you can see it's more closer to that 3% target. So market participants, buyers such as ourselves, are saying, in order for me to invest in a 10-year Treasury security, a 30-year Treasury security, I need to be compensated more for taking on that additional interest rate risk. So I think, until the Fed can kind of get inflation under control, until our federal government can get the debt and deficit picture under control, I think investors are still going to demand higher yields out of taking more interest rate risk by going out to the 10 and 30 year part of the U.S. Treasury yield curve.
Great, thanks, John. Maybe if we could skip ahead to the next page, the valuation page. We mentioned earlier about stocks are not cheap, and the best way we do that is by looking at this price earnings ratio, which here goes back about almost 70 years, and you can see we're sort of at this overvalued area where the price earnings ratios are very high. You can think about the price earnings ratio as if you took the market value of all the companies in the S&P 500 and divided it by the 12 months of net profit, you come up with a ratio. And the higher the ratio means you're paying a lot for $1 of profit. And right now we're sort of in this elevated area, which it could be that if the earnings go up rapidly, then that ratio drops. But it's just not as favorable for investors. It's not necessarily meaning that returns are going to be lower, but over very long periods of time, it does tend to lean in that direction of a little bit lower returns. The next page, let's skip that one, Brian. So this page is something we like to remind clients about because I think the bottom of the page is maybe the most interesting, which is, we have these types of bumps in the road on a pretty regular basis. A 5% decline in the S&P 500 happens about 3 times a year. We had one back in April when the tariffs were announced by the White House. We have a 10% decline about once a year, and then about a 20% decline every 3 or 4 years, and it's been about 3 years since that. Any questions from the board about anything we've already talked about? We did that kind of fast.
I just have a question, Woody. I think I asked this last time about, the tech stocks on the S&P 500 making up the hugely disproportionate amount of that index. And I've seen several articles recently that are talking about an AI bubble. And there's a lot of money, chasing that. there's also articles that are saying, jobs that were thought to be secure, like programmers, I can go get a computer engineering degree, are really at risk now, and before, just a couple years ago, they weren't thought to be, because AI can do a lot of the coding. I mean, you still need somebody to oversee it, but there's a lot of these jobs that seem secure that maybe aren't as secure, and now, more of the hands-on stuff that AI can't do is becoming, perhaps a better career path. It seems like there's just a lot of disruptions and a lot of risk because of that. How are you seeing that?
Well, there's two different factors here. One is how are the companies doing, and how are the employees doing? And investors are probably more concerned about how the companies are doing, because employees, just like other inputs to the manufacturing process, it's a cost. And companies are finding ways to do more with less. If you just look at the last week or so, and you look at the reports from Alphabet, which is Google, or Meta, which is Facebook, or Amazon, or Apple, they've had some remarkably good profit reports for the last quarter. And so, if it was a bubble, you'd probably, I guess that's kind of a counter to the idea of a bubble. They're not necessarily cheap stocks, but they're growing at remarkable rates. And so this bubble term is getting bandied about quite a bit. I think there's no doubt we've never seen anything like a technology, any industry, accounting for what might be closing in on 50% of the stock market value. You have the tech stocks, and then if you added in things like Amazon and Google and Facebook, which a lot of people sort of look at it as tech stocks, or they used to be tech stocks. You're looking at it's a pretty massive number. And Brian, any thoughts from you on that?
Yeah, no, I think you covered a lot of good points. I think importantly, a lot of these large tech companies are generating very significant profits and growing, at exponential rates. I mean, a company as big as Alphabet grew their revenue 16% year over year in this last quarter. So I think there's certainly some concern over how large of a percentage of the index these companies have grown to be. And I think we're being mindful about how much we own of those companies, and there's select companies that we think are overvalued. We don't own Tesla, for instance, which is at 200 times earnings. But some of these other companies that are trading at 30 times earnings, and they're growing at their profits at the rates that they are, we still think are attractive. But as we'll see when we get to the portfolio, just being mindful about how much we own in those sectors, and then even within those sectors, just being very mindful about the valuations of the companies that we do own, so we can be more defensive than the market overall. I think the impact on employees is somewhat of a separate issue, and I think, unfortunately, anytime you have large technological advances, there are disruptions to jobs, and not everyone feels the benefit of that. There will be disruption, and so we can't ignore that. But I think focusing on our roles as investors, I think it largely is positive for the companies that we're investing in, because they're removing costs from their business and making the businesses more profitable.
Any other questions?
I think we're good there.
Brian, you want to? Oh, here we go. Yeah, John. We have a special topic. We try to do this each quarter, and we thought this idea of something unusual that's kind of taking place in the market is what John's going to talk about.
Yeah. Thanks, Woody. So, as you're aware, as we've talked about, across all markets right now is we've seen this broad risk on tone across, again, both equity and fixed income markets. When I say risk on, I mean everybody's piling into the riskiest or riskier of type of sectors, of types of names. We've seen equities continue to grind higher, and credit markets, which is a sector that we are involved with in the fixed income portion, have also followed suit as, again, the overall investor base grows more comfortable taking on risk. So in fixed income, one of the clearest ways that sentiment shows up is through credit spreads. So a credit spread is the extra yield that investors demand to hold a corporate bond over that of a risk-free asset, which we define as U.S. Treasuries. So that backdrop has really been reflected, that risk-on backdrop has really been reflected in tighter spreads and a generally stronger demand for risk assets. And you can see that trend here with spreads continuing to narrow as investors, such as ourselves, price in a more constructive outlook, an outlook where the Federal Reserve appears to be in a more of an easing pattern or reducing interest rates. Growth appears to be moderate. Inflation, again, moderating as well. So this is kind of more of that risk-on constructive outlook that we're seeing, and it's playing through into the corporate bond slide. So you can see on this slide here, what we're graphing is the credit spreads on two different parts of the corporate market, the investment grade corporate market, which is the green line, and we define investment grade as anything rated, any individual corporate bond rated BBB or better. And then we also have the high yield portion of the corporate credit market, which is the blue line, and that's defined as anything below BBB rated. Now, a higher percentage spread on a bond indicates a higher risk premium. In other words, investors demanding more yield to compensate for the greater credit and liquidity risk that they're taking. So a lower spread suggests that investors perceive the issue of this here over the past, call it it's really since that recession back in 2020 that we've really recognized tighter credit spreads. Yes, we've had a blip in the credit spreads, but overall, we're in a territory where spreads are in somewhat of a tight trading zone. Again, no different than equity being very expensive. The corporate credit market is extremely expensive as well. Now, you might say, well, why are we involved in this sector if credit spreads are trading so tight? Well, the reality is we feel very good about fundamentals. I think stable fundamentals are extremely important here. As I look at spreads across even just year to date, they've remained very range bound here, even as we've seen Treasury yields move lower. I think if we look at some of the individual corporate names, balance sheets remain extremely healthy. One of the things we like to look at in the corporate credit market is leverage. So if an entity, an individual name is taking on additional leverage, maybe it be through mergers and acquisitions where they need to fund the acquisition, we are still seeing balance sheets extremely healthy. They are able to get refinancing done or financing done in the market at a very efficient rate. So sometimes when they do come to the market with new fixed income bond issues, one of the things we like to look at is how easily they're getting these deals done. And for the most part, year to date, we've seen they are having no problems getting deals done. In other words, investors continue to have that appetite for the corporate credit market. Valuations again are concerning to us. So what we've generally done in portfolios is be careful with the amount of interest rate risk we're taking with the individual credit names that we're getting involved in. So we're making sure from a fundamental perspective that we like the names we're getting involved in, and we're making sure not to take on too much interest rate risk with each individual name, with the thought that because valuations are so tight, because spreads are not offering as much as they may be historically, that there may be a better opportunity to get into some of the corporate credit names. Now, I think all-in yields, when we look at, even though the spreads that they're getting above that of a treasury are not as appetizing as they maybe once were, we think the all-in yields still remain compelling, even if that spread compression is not potentially there as it would be in the past. So one of the things that we'll keep an eye on moving forward are certainly earnings. As we're getting through the meat of earnings season here, we'll take a close look at some of the names we're involved in, making sure that we're seeing solid corporate earnings. We'll look at monetary policy. So we'll look at what the Federal Reserve is doing, and they're on an easing cycle, and that provides a more accommodative environment for corporate names to get deals done in the market. And certainly we're looking at the trade uncertainty that is kind of some of those political or fiscal pressures. When you get more volatility into the equity markets, we would see the same thing in fixed income markets. We had that tariff kind of tantrum here in April of this year. Certainly the headlines are not done, but I think we're past a lot of those tougher kind of headlines. So we'll certainly keep an eye on that. And then lastly, I'll just talk about just the government debt. So as government debt continues to rise, yes, they're seeing some offsetting from some of the tariff revenues that they're receiving, but rising debt levels can pose risks to financial stability, and that would certainly play through to the corporate credit market. But as I look at the market today, as I look at these spreads, yes, they are very compressed, but the all-in yields that we're getting are still very attractive, but we're still keeping an eye on the fundamentals as we look at the individual names in your portfolio.
Thanks, John. Any questions on the credit spreads? A little bit of kind of inside baseball. Okay, let's see here. I'll pick up here. You can see here kind of a snapshot of the portfolio. You can see as of the end of September, we're still over $15 million, and the internal loan has been paid off, and we're slightly overweight in common stocks. If you look at the target allocation, we have 65% targeted, and we have about 66%. So we'll probably rebalance a little bit. Actually, I think there's another topic coming up later on that Ed's going to talk about in terms of the asset allocation. So maybe we can go to the next page, and you can see how the portfolio is allocated among the 11 S&P groups, starting with information technology down to utilities. Those are the 11 components of the Standard & Poor's 500. And we've broken it here into, if you look along the left, sensitive, cyclical, and defensive. And we tend to be a more defensive portfolio, which means we do better in difficult markets. We sometimes refer to this as an all-weather portfolio. But we also, because of that, we tend to lag in very strong markets like what we've had recently. And let's see the next page. I think we've already talked a lot about fixed income. John, maybe you could take less than a minute hit on this one.
Yeah, sure. Just looking at that top right table is really what I'll focus on here. Is you'll notice that when we look at ourselves or your portfolio versus our index, you'll notice we're not taking on any undue interest rate risk with our average duration of just shy of 3.7 years, so about equal to what our benchmark is doing. But you'll notice we're doing so with providing some additional yield on top of what the benchmark is providing, and we're really getting that through kind of our overweight in the corporate market, which you'll see in the bottom left of the sector distribution. Just talked a lot about that. But it's maintaining that high quality portfolio as well, which is extremely important in this type of environment. But if you look at that maturity distribution bar chart, fairly equally weighted across all of those different time periods, and I would expect over the future that we would maintain kind of that maturity distribution across the portfolio.
Brian, you want to pick up here?
Yeah, the next two pages, 17 and 18, show a history of the balance of the fund and the distributions that have been made since inception in 2008. And so I'll just point out the fund began at about 6.7 million. You can see the spend rate over time has declined to about 3.5% annually now. But total distributions between the regular annual distributions and then a couple one-time distributions, which we haven't had in a while, have totaled about 7.4 million. Yet, the account has still grown to 15.3. So from 6.7 has grown to 15.3, and also distributed 7.4 million over time to the benefit of Manistee. So.
I think, Ed, you do these calculations, but you can kind of tell that the city's capital budget will get a raise for this next upcoming distribution. And that's nice to see that progression if you look at the distributions for the capital budget line and how over time that's gone up nicely, reflecting the market, a good market.
Yep. I think maybe the only other comment I'll make on this is as the spend rate has declined over time, what that enables the fund to do is it really does allow you to take more risk potentially and grow the account more over time. And I think that'll fit in nicely with Ed's conversation here towards the end on asset allocation. Page 19 is the performance update. And so year to date, the City of Manistee Fund has grown 8.5%. That's through the end of September. And if you look below the asset class blue row here, the equities have grown 10.9% this year. Fixed income has participated meaningfully as interest rates have generally declined this year. That helps with fixed income prices along with the yields that are interest that we're receiving. So that has grown to the tune of 5.5%. And cash returns through the money yield, even those yields are coming down with Fed rate cuts, still growing 2.7% for the year. So all of that adds up to 8.5%. I'll also point out that foreign stocks have been the real bright spot this year. So this MSCI All Country World ex-US Index is an index of international equities, primarily Europe and Japan and Australia. It's basically doubled the return of U.S. stocks this year at 26%, and a lot of that has to do with the weakening dollar, mostly driven by tariffs this year. We focus more on, 9 months is a relatively short investment time period, but if you kind of focus more on the 3, 5 year, 10-year numbers, all of those time periods include a number of large market disruptions. If you kind of think back to the page that Woody covered earlier, that showed the how common it is that we have 10 and 20% declines. Well, there's a number of those declines of that magnitude, especially if you're looking at the 5 and 10 year numbers. So annual returns on average of 7.9% for 5 years and 8.9% for the 10-year return. So, any questions on performance?
I think we're good.
Okay.
Ed, did you, we talked about some things earlier. Did you want to delve into anything?
The next thing on the agenda, Woody, is the meeting dates, and then we'll get into that topic.
I have one question, and if we're moving on from this. On the cash flow and distributions, page 18, if we're not getting royalties, where does that number come from? We're saying in 25 it was 21,070 oil and gas royalties. I'm just confused because
I'm
I
sorry.
thought we were saying we're a year behind. So if on here,
Yeah, I think maybe I'll have to get with Woody, the fiscal year end, because we're not in fiscal year 27, we're in fiscal year 26. So, I think there's something off on the year column, but we haven't gotten any royalties. So the column that says fiscal year in 2027 year to date should be fiscal year 2026 year to date. So I think something's off there in the actual columns, needs to get shifted back a year probably. So we haven't gotten any royalties for over a year.
okay, so the 0 is correct, but the year is
I
probably.
think I'd have to double check what.
Okay.
But we're clearly not in fiscal year 2027. So,
When was the last time you received one, Ed?
it's been over
Recollection.
a year.
Okay. Yeah, looks like we need some work here. But we don't have anything else prepared.
Are we good? I don't know what we're moving on or.
Yeah, we need to do the meeting dates and then I'll talk about the asset allocation stuff.
I'll make a motion to approve the meeting dates as distributed, which would be January 16, April 17, July 17, and October 16, knowing that they all may or may not be changed depending on schedules.
I'll support.
Okay, all in favor?
Aye.
Okay. Kelly, do you want to pull up that one PDF document?
Yeah.
Maybe share it. So Woody and those guys can see it. It's an Adobe.
It's on a oh, okay.
There we go. Can you guys see that, Woody?
No.
No.
You need to share the screen on the Teams meeting.
Oh, okay, on the team meeting.
Can you guys see it now, Woody?
Yes.
Okay.
Yes.
So we talked last month briefly about potentially considering recommending to council to increase the asset allocation and equities from target from 65 to 70, and then you'd reduce the fixed income. But I wanted to take a step back and just go all the way up to the top. So we've talked about the whole idea of the oil and gas fund is to preserve the purchasing power and have intergenerational equity between current spending and future spending. And the purpose of our spending rule and smoothing it over 12 quarters is so that we can have smooth distributions for our capital fund, regardless of kind of market conditions. And so I think that these charts, I just wanted to kind of refresh you guys on, it demonstrates that we've done that and it will continue to do that. So if you just scroll down a little bit, you can see our earnings in the oil and gas fund. In this chart, go down just a little bit. So this chart goes all the way back to 96. Keep in mind, from 96 to 2008, we were basically invested in CDs. So you can see there's very little volatility in the earnings just based on kind of interest rates. But once we got to 2008 and we started to be able to invest in things that gave us higher yields, you can see we've had tremendous investment returns with a few down years, but overall it's been tremendously positive, and you can see that with the value of the fund going from just under 7 million all the way up to over 15 million. But if you look in there, there's been 3 years where we kind of had some negative either reduction in the fund or really low earnings, 15, 16, and then 2022. But they rebounded right back. So if you go down to the chart right below that, Kelly. You can see even with those ups and downs, the trend has been steady. So every time it went down, it's come back up and recovered, and that's how this fund is designed to work. So I think from there, I'd say mission accomplished. So then the question becomes, okay, we've done this with a variety of asset allocations and spending rule allocations, and the asset allocations we've increased at least 1 or 2 times on the equity side. I think it started at 60 or maybe even 55. I'd have to look back, but the topic that we're contemplating, or the change, would be to take it from 65 to 70. So if you scroll down a little bit, Kelly, to the next page. Woody and I chatted through this. I did some other calculations, which I think are a little too complicated to pay you. I tried to distill it down. But basically, if you were to change the asset allocation from 65% to 70% stocks, you'll add about an additional 4% yield. And that 4% yield is the difference between what you pay on fixed income and what a typical stock market return is. And that would be 5% of 15 million, using round numbers, is about 750,000. So an additional 4% on 750,000 on an annual basis is about an additional 30,000 per year. And again, that's on average, and that will compound over time. So that's what that change potentially gives you. Now, on the downside, it will increase the maximum expected reduction in a worst case scenario by about 300,000 in a given year, from going to 65 to 70. So if you scroll down just a little bit on this chart, what this shows is on different asset allocations, what the worst return is and what the average return is. So if you look about 2/3 of the way down on a 60-40 portfolio, that's not quite what we're at. We're at 65-35. But the worst return on that portfolio is a negative 26.6%, whereas the best return on the right side is a 36.7%, with an average of about 8.8. And if you go down to the next line, 70-30, the worst case scenario is about a 30.7% decline, and the best case is about a 41.1% decline. So we're actually somewhere in between there right now. So basically, you introduce a little bit more volatility into the portfolio because stocks are a riskier asset class, but you also increase on the upside on that. And the trend for stock markets, keep in mind, is up. If the trend was just flat, this wouldn't make any sense, but because it's up, that tends to compound over time and continue to grow that fund. And so I think that's a reasonable suggestion to make. I think a lot of endowments are moving toward that. One of the things we have to keep in mind is we still give the investment advisor flexibility. They have a range, and that's what's spelled out in Appendix A of our spending policy. And so they, if market conditions are extreme, they don't have to be at 70%. They can be right now as low as 50% equity. So they have that flexibility, and we would continue to give them that flexibility. But the thought was maybe we try to adjust that target up and then let them work towards that. As Woody mentioned in his presentation, right now stocks are kind of expensive based on historical valuation, so they probably wouldn't do that right away. The reason they're at 66% now is because stocks have run up and they haven't rebalanced totally yet. So, they have the latitude, and that's what we're paying their expertise for, to try to move towards that. But I think that's something that, again, over the long term would greatly benefit. It doesn't seem like a big change, but over multiple years it will make a big difference in that ending value. And the downside risk, given how infrequent recessions and stuff happen, don't make that much difference, especially when you're in it for the long term. It's like a pension fund, you just ride those out. That's what the fund is designed to do. So my suggestion is we consider moving that, and then we would have to put that in front of council if it was approved by this board, because they have to approve any changes to the policy. Woody, do you have anything to add, or Brian, or anybody? You're muted, Woody.
I think you said it pretty well, Ed. I think what we've learned is when we started 16 plus years ago, we really didn't know what the risk tolerance of the board was in terms of how you deal with volatility and a significant decline in the market. And I think you guys have shown that you handled that pretty well. You're very thoughtful and focused on the long term and not subject to the emotionalism of short-term movements. And as a result, we've sort of slowly increased the equities maybe a few times. It may have even started, like as Ed referred to, 55%, went to 60, 65, and the 70, or possibly even 75, might be more representative of how endowments and foundations with very long-term orientations would typically invest. So, we think the 70% is a good target right now. You'll get a little bit higher returns over time. The spending, you'll get a little bit more of a distribution over time. Again, these are over long periods of time, but I think it's a valuable, very valuable asset for Manistee, and we're just trying to align the long-term goals with the investments.
Yeah, the only thing I'll add is that the average return from 8.8% to 9.2 may not sound that meaningful, but that there in dollar terms that works out to be about 30,000 of increased return. But that compounding over time, especially when you're thinking of the purpose of this fund, which is in perpetuity to support the city of Manistee. That extra almost a 0.5% return will be very, very meaningful, compounded over a large number of years. So I just ran a simple financial calculator off to the side, and if you ran 8.8% or 9.2% on a portfolio of 15 million over the next 10 years, it's a difference in value of about 1.3 million. So that number will just continue to increase over time. And I think given the relatively low spend rate at 3.5%, we see a lot of foundations or nonprofits, what have you, with higher spend rates than that. That allows you to take a little bit more risk, and that compounding that you get from taking extra risk will just be to the benefit of the city over time. So.
Well, really, above all we're doing is taking the paid off, that have been the loans that the oil and gas has done, and putting it in stocks. We used to have sort of three buckets. We had the local loans that we had out, stocks and then bonds. And now the local loans are gone, and that money's, I realize the dollars are a little different, but it's going now into stocks rather than split among the portfolio.
Do you want to make a motion to bring this to council?
So is there any discussion? I guess we've talked about it a little bit, but it's not a huge change. It's kind of just more of what we've been doing, but I just wanted to make sure everybody had a chance to ask any questions while we've got them on the line as well.
I think it was stated at the last meeting possibly that, we increase it by 5%, but it's not overnight, and they've done a good job of easing into it and buying them when they're, not at their all-time high.
Market conditions, we might not get there for a year.
Yes, exactly. So it doesn't mean it's going to happen tomorrow, or once we give them, this council gives them the permission, it's not overnight, because they've done a good job of knowing when to buy.
So Woody, I did have a question. I was looking at the appendix A, and I know you don't have the benefit of looking that in front of you, but that table shows the minimum percentage, maximum percentage, and then target, and it has total equity, U.S., non-U.S., and then total fixed income, and then cash. And I know we wanted to modify the targets, but I think we need to take a look at the maximum minimums and at least adjust the maximum a little bit. But I don't know if the minimums need to change, but maybe you and I could take a look at that. And I can, because we probably need to tweak that a little bit too by the same percentage, 5% or something.
Good point. Yeah, we would adjust those accordingly.
Yeah.
Just kind of move everything up a little bit.
So I guess I would make a motion that we change the benchmark asset allocation on equities to 75% for target and for fixed income to 25%, leaving cash unchanged.
Why? And I think we talked about 70, didn't we? Or did you want to go to 70?
Yeah.
It's a 70.
70.
That's what I have.
Yeah.
70%, fixed income to 25%, leave cash unchanged at 5%. And then, we will adjust the minimum and maximum accordingly and bring that back to council at a future date for approval.
I think Ed mentioned this, but we don't plan to take any action right now, but over time we're going to let it drift up. But if markets were to take a significant correction, we would then use that as an opportunity to get it quicker to the 70. But right now we're just going to let markets do their work, and to the extent it gets us to 70, we're happy with that.
Do you want to voice that?
Yeah.
We can do roll, let's do roll call.
Okay, roll call then. Jermaine Sullivan,
Yes.
Liz Lasky,
Yes.
Doug Parks,
Yes.
Ed Bradford.
Yes.
Thank you. Anything else?
Done.
No?
Gentlemen, thank you.
Thank you.
Thank you.
Okay,
Have an enjoyable Halloween.
Yeah.
If you guys are so inclined and you stream radio, I gotta do a plug for this because it's awesome. WTCM, which is a big country music station up here in Northwest Michigan, 103.5. They do The Haunting of Northwest Michigan at 6:20 tonight, and then they have an encore performance on Saturday, and it's awesome. It's like 3 or 4 little short Halloween stories. They're normally pretty well done. So if you guys find
6:20
iHeartRadio or something, it's worth listening to. It's the highlight of my Halloween.
Is that WTCM as in Traverse City, M as in man?
Yeah, WTCM 103.5, and it comes on at
Okay.
6:20 tonight. So I'm pretty sure they live stream it somewhere. If you go on YouTube, you can find the past ones that they've done, and they're pretty good. I like them. Anyway, if you're bored tonight.
Yeah.
Great. Well, thanks for the tip. I'll have to get my 7-year-old grandchild to listen to it and get them spooked.
thank you, guys.
Thank you.
Thanks, guys.
Thank you.
Everybody. Okay. Thank you. Thanks, Kelly.
Thanks.
Public comment, we have none, so motion to adjourn.
Support.
Yeah, I'm glad you put that on there because we might not be